This week on Bullshift, the podcast, we're talking to Dan Hallett. Dan is a principal at Highview Financial, and we're talking about the risks associated with the way products are rated. There are things that you're going to find that might very well surprise you a great deal. Welcome to Bullshift, the podcast. This is the podcast that talks about how the financial services industry shifts your attention to make you feel more bullish. My name is John DeGuy. I am the author of the book Bullshift and the host of the podcast. My guest this week is Dan Hallett. Dan is the Vice President, Research and Principal at Highview Financial Group. He has 30 years experience in the industry as an analyst, advisor, and advocate. Dan, welcome.
Thank you, John. It's a pleasure.
You and I have known each other for some time, and I reached out to you because a mutual friend put out some information recently based on a proposal that you made long ago, maybe a decade ago, about the way mutual funds are rated for risk. Could you perhaps take a moment to walk us through a very high level overview of mutual fund risk rating as it exists in Canada in 2024?
So as it exists today, the method that's used to assess risk for funds is very similar to what was in place before the rule was formalized. And it's all based on volatility or the standard deviation of returns of each product. And so essentially what happens is there's a standard deviation calculated for the life of the fund or 10 years, whichever, it goes back as far as 10 years. And whatever the annualized standard deviation is, it's sort of mapped to a scale ranging from low to high and a few ratings in between. And that's essentially the rating that you see both in prospectuses, but also in the fund facts or ETF facts for that matter. Right. But that's the method that's in use today. And it was similar to what was used before.
Thinking about what you were talking about way back then when we were still chewing around how we were going to rate products and what we should think about, one of the things that you made reference to was something called the Flesch-Kincaid grade level test. And you said that a lot of these fund facts and prospectuses were being written for the grade 6 level, and that a lot of what was written needed to involve context. What is your view on the extent to which the typical mutual fund or ETF investor reads and comprehends what they have read when they get a prospectus or fund facts?
Oh boy. Well, let me first just touch on that scale. First of all, I hadn't heard of it prior to writing about it in that submission. But as part of kind of the, for lack of a better word, promotion of the fund facts disclosure document, something regulators promoted was it reads at a grade 6 level. So when I looked into that, all it is the number of words divided by number of characters or vice versa. I forget what it was, but it was just some formulaic, based on the words and characters on the page. And I thought, well, what does that matter? So, the context is very important. I can use lots of very small, all it says is we don't use big words. If you use very small words that people don't understand, it doesn't matter what the scale tells you. But, I don't know that people still read those documents all that clearly. I think certainly they don't read prospectuses. I think I feel pretty safe in claiming that. I have no proof of it, but it's just, 30 years of observing and talking to people. And I'd say probably more people look through the fund facts because it is, more like a profile fact sheet that you'd find on a website. It's got that kind of layout, but I still would suspect that most people aren't really thoroughly reading through it and understanding all of the key elements that they need to or should be grasping as a result.
So let's talk about that then, and what people understand and don't, and the risks and limitations of what goes into the disclosure of a product. Right now, financial advisors have an obligation. They have to know their product, KYP, and they have to know their client, KYC.
Yeah.
But when they come together and they recommend products for clients that are suited to their circumstances, that the tests are that you need to be fit for purpose in terms of their risk tolerance and risk capacity. How well do you believe the risk ratings of products map into intuitive risk tolerance and risk capacity streams?
Not at all. I don't think, I mean, first of all, the standard deviation itself is a useless number on its own, right? It needs to be paired with an average so that you can map some range of potential outcomes. But it's even less meaningful when essentially regulators are taking a numerical figure and then translating it effectively to some sort of description of risks, such as medium or low or high. Mm-hmm. So I don't know how someone can take someone else's definition of, let's say, medium risk and figure out if that's a fit for them. What they're going to do is see medium risk, I think, and, you know, assign whatever meaning that means to them, any association they have with that. But I can almost guarantee you it's not the same level of risk. So a lot of 100% stock funds are medium risk. Right. And there's no way that the amount of volatility is going to meet most people's definition of medium risk when they think about it.
Certainly my observation is that there are a lot of individual products that are made up of entirely stocks and some entirely bonds and some balanced products that have combinations of stocks and bonds. And they all, almost all, many of them are rated as medium risk. And so when everything is sort of middle of the road and gray, it's very difficult to capture that nuance. And what I think I heard you say, and I don't want to put words in your mouth, is that risk means different things to different people. And that standardization is it's very difficult, in fairness to the regulators, to come up with a simple single test or definition of what risk is, because you and I and another person listening might all define it differently. And we might all be right in our own world and our own purview.
Yes, no, absolutely. But I think if you were going to come up with one standard definition, I would bet that, because I've not studied this in any formal way, but again, just from speaking to so many investors and dealing with a lot of clients over the years, I would bet that something along the lines of how much a fund could lose, or how much, even more meaningfully, a portfolio could lose in a bear market, for example, and how long it might take you to recover. Those, to me, are intuitive, easy to understand, and aligned with the things that people will experience and see on their statements and reports month to month, quarter to quarter. So to me, that's aligned. They're not seeing that standard deviation number. Not only they're not seeing it for any of their funds after that initial point of sale, they're certainly not seeing it for their portfolios. And even if they did, what are they doing with that info? It's, so it's, I think it should be matched with what's in that regulatory document, that they should be able to see progress on their ongoing reporting. But there's no connection between that initial risk rating and what they see on an ongoing basis.
And so I strongly agree. And one of the things I say repeatedly in Bullshift is that if we could only find a way to better calibrate these things, because I think risk, you're exactly right. The real questions are, how much can I lose? How long will it take me before I get my money back? And how bad will the loss be? Yeah. And most people, in my opinion, have no idea of what their actual risk tolerance and risk capacity is. It's an amorphous, ill-defined sort of notion. And my personal view is that most people can't handle as much risk as they think they can, and the industry is walking them, whistling past the graveyard saying, oh, don't worry, you'll be fine. Just take a long-term view. And taking a long-term view is all fine and well if you're 40 or 50, but if you've got a 60-40 portfolio and you're in your 70s and you're retired, not only do you not have as much time, but you also can't buy the dip. Like, you can't buy more because you're no longer working. Whatever you have invested is all you have in the world. And so the risk capacity in particular is something that I think a lot of people overestimate, and they have no idea what their real capacity is because we haven't really had to test it. So the one thing that I would use as an example, and I'm curious to hear what you think, is our last really major drawdown was the global financial crisis from 2007 to 2009. So peak to trough, it lasted less than 2 years, and then we started coming back up again. So in terms of how long do you have to wait before things start coming up? Well, the answer is less than 2 years. And how much money could you lose? Well, on the stock portion, it was more than half. On a balanced portfolio, it was probably more like a third. How long do you have to wait till you get it back? Most people were back to about where they started within about 5 years, 6 years. So that if you started losing money in 2007, certainly in 2008, then usually by 2012, 2013, you were pretty close to back to where you started. How do you think people would react if something were, say, to be a little more severe? If it were to drop for 3 years instead of 2, and it were to take 8 or 10 years to come back instead of 5 or 6, do you think people could handle that?
I think certainly people are not expecting that. So if we put that in context, like global financial crisis was certainly worse than your average bear market over the last 140 years. If we just talk about the U.S. market, the average is something like losing about a third of your value, and being underwater. So peak to trough to recovery. So being underwater about 3 years, more or less. So those are sort of average stats over, the past 140 some odd years. So global financial crisis was certainly worse than that. In 2020, I mean, if you blinked, you kind of missed it. Although the drawdown was about average, about a third on equity markets. Would people be prepared for like a 60% drawdown and underwater for like 8 years? Probably not. But the other thing is people aren't just invested in the stock market for the most part. They are invested in other assets that should, not always, but the majority of time, soften the blow of those drawdowns. So like I didn't look this up because I didn't know we were going to talk about this, but I remember way back looking at the Depression era. Right. And so even on a total return basis, the drawdown was horrible. It was like minus 83% or something on using monthly data. And I think it took like 15 years to recover on a total return. I think it was like 25 years if it was price only, like just using the price index. But if you just looking at a hypothetical 60% US stocks, 40% US bonds, the recovery was something like the drawdown was still massive. It was still something like 50 or 60%. But the recovery, like the total time underwater was something like it was less than 10 years. So it wasn't as severe as you'd think it would be. So to answer your question, I don't think people are expecting that. I don't think they're prepared for it. But like anything else in life, when something worse than expected happens, it hits you really hard. Maybe you panic. Maybe some people panic. I think for most people, they just kind of freeze. They're like, what the heck just happened? But I think people adapt.
Right.
It's not easy. It's not a fun process, but you get through it. And I think having that, being invested in more than one type of asset helps in that process, if that happens.
I've got a couple of questions I want to talk to you about that. So first, let's talk about the other assets. The obvious thing is alternatives. People these days talk a lot about alternatives, and their alternatives have different There are liquid alternatives, and there's real estate, and there's,
Yeah.
long, short, and hedge funds, and whatever, crypto assets. There's a whole series of different things that might be considered alternatives.
Yeah.
A lot of those things, and I don't know what a more appropriate portfolio might be, but for purposes of our discussion, let's just say where a traditional balanced portfolio was 60% stocks and 40% bonds, a more conventional using alternatives portfolio might be 50% stocks, 30% bonds, and 20% alternatives. One would expect that a portfolio like that would be a little more stable, a little less volatile. The returns might not be higher, but at least the drawdowns will be less, and that should help people to deal with a major drawdown, whatever that looks like whenever it happens. Who knows? I don't know. I'm just saying, I just don't think, my personal view is that whenever it happens, why ever it happens, I don't think people will be psychologically prepared, because they've been sort of spoon-fed a bill of goods that we're going to be fine, and people haven't really thought about what a really serious drawdown might look like.
So are you saying that the alternatives won't do their job in that worst case scenario? Is that kind of what you're saying, or just they're not prepared at all for that?
I think whatever it looks like, whenever it comes, people are not as ready as they think they are. I'm not going to say they're totally unprepared, but they're not as prepared as they think they are.
I think that's fair.
And I think using alternatives in theory ought to help. Now, in practice, we don't know until we actually experience it. I'm not want to forecast what it's going to look like or why or how, but in theory, it would seem to me that using alternatives might help soften the volatility along the way, if nothing else.
I think that's fair as a general statement. It obviously depends what's in that broad bucket of alternatives for a given portfolio. The other thing, just to your earlier point, even for people who did live through with a portfolio through the financial crisis, for example, it's still, the next one still might be harder to deal with, even if it's the same. Let's assume it's not a worse drawdown and it's more drawn out time-wise. But if you were around in 08 and you're still around now, and you're still, whatever stage you're at, you probably have more money invested than you did then. So the dollar losses are bigger. So so it's reasonable to think that even if you have the same tolerance for risk in a way, you could be more sensitive to those, downdrafts, because now there are much bigger dollars involved, 15, 16 years later.
And there are fewer working years left in your career to make up the shortfall as well. So it's a double whammy. It's not only are the absolute dollars lower, but the time that you have to make it up is reduced. Yeah. Can you weigh in on the impact of the work? About a month ago, Daniel Kahneman died. And Danny Kahneman is known with Amos Tversky for a number of things, perhaps most famously for his work on prospect theory, specifically loss aversion, and how the feeling of regret and remorse is twice as acute for a downdraft as it is for a move upward. What do you think about loss aversion as it pertains to the possibility of a major drawdown?
People, the work was really important because it actually put some real rigor to a lot of the effects, I think, that people were observing anyway. Right. But in terms of, people are very sensitive to losses. Some people hypersensitive. And part of that is, I think, is addressed through education and reinforcement of that education. But invariably, that is an issue. And, the next time we have a bear market, I don't think you can ever do as much informing and educating of people to completely offset that effect. Mm-hmm. People are just very sensitive to losing money. And again, I think as people's portfolios grow, they become more, that's just my theory, people become more sensitive because the dollars at stake are bigger. As you point out, the time to recover, people don't have as much time as they age. So I think that's something that that should be incorporated as best you can. But it is a difficult thing to formally incorporate. I think one of the ways you deal with that is through diversity of assets, diversity of different exposures in the portfolio, different economic influences. But there's a limit, right? If you get to the point where you've eliminated all those risks, you should, in theory, be sitting with T-bill returns, and probably less if you've done it in a more complicated way rather than just buying the T-bills. So,
right. Yeah. Wondering if you can weigh in on the concept of behavioral coaching. A lot of financial advisors will say that their value proposition is behavioral coaching, and part of my, let's call it cynicism. I don't think of myself as being particularly cynical, but I'm also not around the block for the first time. There are certain things that I was like, okay, I'm from Missouri. You got to show me. A lot of advisors will say, well, my value proposition, what I bring to the table when I work with my clients, is I'm a behavioral coach. And my rejoinder to that for many of these people, because again, everything is different clients react differently, is that it's easy to be a good behavioral coach in a bull market. And I'm less convinced that advisors will necessarily be able to do a good job. Some will. And I think part of that comes from miscalibrating the risk tolerance and risk capacity in the first place. And then we can then discuss where the culpability for that lies. How well do you think advisors can do truly in coaching their clients through tough times if in fact we have a drawdown like we were discussing 5 or 6 minutes ago?
Okay. So I think there's validity to the notion of behavioral coaching, but I think trying to discuss it in a high level generic context is not that meaningful, right? Because it depends obviously on the advisor, but it also depends on the client we're talking about. Right. Some people don't need it. Even the ones that have chosen to engage our services, your services as professional advisors, some of them, they get it. It's like, no, I know this is just part of the deal when you're invested in markets. It's up, it's down. As long as it's within the realm of their expectations, they're good. But trying to put a number on it at a high level, as some studies have done, I think is a bit silly. Right. Because like I can remember, but there's real value to it, and I say that just based on, again, my anecdotal experience. But I can remember a lot of people in the mid 2000s that I just happened to come across. A lot of them, let's call them 70-plus-year-old couples that were sitting with 85 to 100% in stocks. And just through a process, got them invested in something more appropriate, which was something more balanced. But I'm convinced had they not, come across, and I think most advisors would have done something similar, got them to a point where they could structure a portfolio that they could sort of live with a bit better. That they might, I don't know if any level of behavioral coaching would help them. But I know we've talked a lot of, and you've probably done this, we've talked a lot of clients out of knee-jerk reactions that would have worked out terribly. And even just trying to time things. The number of people, the last 2 US election cycles, we had lots of people who just didn't want to put any money to work until after the election was done. And both times it backfired on people. So there is real value in that coaching, but does the entire industry, does everybody provide value on that front? Absolutely not.
Okay, let's see if we can get to the wrap-up part, which is the first part is that's bullshit. If it was up to you, Dan, what would you point to as being something in the financial services industry that could use cleaning up, that you could improve upon?
Well, as I think about this, the thing that has kind of come up over and over again, and it's kind of bubbled up recently, is misleading advertising and marketing. And this has been a theme pretty much throughout my career, and I'm sure throughout yours as well, in various forms. And I don't know that there's a real solution to it, but like the latest example, and I'll sort of describe it without naming the actual product, but there's a mortgage fund that I have seen for years, just advertised week after week after week in papers, physical papers, online in various platforms. It's the same theme. They use, kind of local TV celebrities to promote the product. They take a quarterly distribution and annualize it and call it a 1-year return or an annualized return. Like, they're doing things that mutual funds aren't even allowed to do. And even on the compensation front, they're paying things. But to me, it's just completely misleading. And that's the stuff that really kind of burns me up. And but I don't know. Is the solution being overly prescriptive and saying here's exactly what you have to do, or
here's where I ask you, what's the solution? So now we get to shift happens. If it was up to you and you were to find a way to do whatever you had carte blanche, you could do whatever you wanted as a means of solving the problem you've just identified, which is misleading advertising. How would you at least attempt to tackle it?
I don't have a good answer. I just have a good beef. I don't have a good solution to it. I have a lot of beefs and not as many solutions as I'd like. I don't know. I mean, with this one in particular, so I think the idea of misleading advertising in general, there has been some good progress made, right? I mean, there are some very specific things in terms of if you're advertising performance, for example, here's what has to be included. The problem is this product is not a regulated product. It's an exempt product. So when it's not regulated, how do you regulate it? Right. So I don't know what the solution is for that, but I know they shouldn't be doing what they're doing. And maybe the solution is just highlighting that, shedding a little bit of light on what's happening. And I've done it on a very small scale, and, but I don't unfortunately don't have a really good solution to get rid of that. Because if you do too many rules, then someone else will figure out a way to wiggle in between them.
Great. All right, Dan, that's it for me. I think that's been wonderful. I've really enjoyed the conversation. Thank you very much for your time and your insight. Likewise. And I want to wish you all the best.
Thanks so much, John.
John DeGooey is a portfolio manager in Toronto and the author of the book Bullshift: How Optimism Bias Threatens Your Finances. Bullshift is available online and in bookstores everywhere. The opinions expressed in this podcast should not be construed as investment advice. Bullshift, the podcast, is produced by TalkShoe, a division of IOTM.